Welcome back to the Digital Ledger. This is the 2025 Tech M&A Insights edition. Today, we break down the M&A landscape through the lens of controllership, valuation, and capital allocation. We're focusing on the financial implications of the 2025 M&A trends, analyzing the data points that truly matter to corporate accountants and finance leaders.
That's right, Kathy. In a market defined by uncertainty and massive transactions, precision in modeling, diligence, and reporting is more critical than ever. Let's start by looking at the pressures stemming from the global economy and how they are impacting valuations and financing.
Before we dive in further, we value credibility, and we want to make sure that we are fully transparent. AI plays an active role in generating and shaping this podcast, from supporting research to assisting with certain elements of script creation. At the same time, all fact validations and the majority of research and creative decisions are made by our human team. This blend brings together the best of both worlds.
Coming back to our main topic, 2025 Tech M&A Insights, we should begin with the macro factors that are fundamentally shifting the cost of doing deals. While there is a continued trend towards larger transactions, external shocks are creating a high-cost financing environment.
We are seeing a significant disconnect between deal volume and value this year, aren't we?
Absolutely. Global M&A deal volumes continued to decline, dropping by 9% in the first half of 2025 compared with H1 2024. However, deal values are significantly up, increasing by 15%, driven by a trend towards larger transactions, with megadeals, greater than $5 billion, up 16% year over year. This focuses attention squarely on the financial viability of larger balance sheets.
And the viability of those deals is heavily influenced by interest rates and public debt.
Correct. Long-term interest rates in the US and Europe are persistently high, defying gravity. This is compounded by rising government debt in OECD countries, which is expected to hit $59 trillion in 2025, or 85% of GDP. For corporate finance teams, this is a critical concern because high public debt increases financing costs, creates fiscal uncertainty, and can dampen investor appetite by strangling economic growth.
When we look at overall valuation, has that higher financing cost filtered through into global multiples?
It has. Median global M&A multiples, measured as enterprise value to EBITDA, have fallen back to 10.8x in the first half of 2025, a drop of approximately 14% compared to the fourth quarter of 2024. This signals that deal pricing remains sensitive to high financing costs and economic uncertainty.
When we look at the technology sector, the pressure is on accounting teams to prove strong unit economics to justify the high multiples this sector still commands. The focus is increasingly on capability-driven transactions, particularly those involving AI infrastructure and talent.
The core focus remains on profitability metrics and strong revenue characteristics, especially in the software as a service, SaaS, space.
The two biggest factors differentiating strong from weak SaaS companies are the Rule of 40 and net revenue retention, NRR. Let's start with the Rule of 40. This metric, annual revenue growth rate plus EBITDA margin, is essential.
And it directly influences the multiple achieved. For private SaaS firms in 2024, the median revenue multiple was 4.1x, and the median EBITDA multiple was 19.2x. However, the current median revenue multiple for a publicly traded SaaS company is 7.5x, showcasing a significant public premium.
NRR has an even more dramatic impact on valuation. Public SaaS firms with NRR greater than 120% had a median revenue multiple of 11.7x at sale. Contrast that with public SaaS firms with NRR below 90%, which had a median multiple of only 1.2x. This data confirms that accounting for and maximizing retained recurring revenue is absolutely essential before a sale commences.
It also highlights that deal negotiations in 2025 will heavily revolve around quality of earnings and retention rates, factors that influence the final price and whether a buyer requires an earn-out structure.
Given the pervasive uncertainty, corporate accountants involved in M&A must prioritize strengthened scenario planning. This goes far beyond typical stress testing. We're talking about systematically mapping out a range of macroeconomic, regulatory, and geopolitical outcomes.
Absolutely. Companies in tariff-sensitive sectors like pharmaceuticals and automotive are already embedding these assumptions into their cost models. Accountants must carefully vet model inputs, especially variables affected by potential tariffs.
Interestingly, the market seems to be pricing in some regional differences regarding that tariff risk.
That's where we see a fascinating geographic divergence in valuations. While median global multiples declined, median multiples in the U.S. have actually risen in the first half of 2025 relative to late 2024. Conversely, they declined in Europe and Asia-Pacific. This divergence may signal that dealmakers are making a bet that U.S. companies are positioned to weather tariff wars more favorably.
That is very interesting.
Yes, and for larger transactions, where pricing has declined recently, that decline may be a function of greater exposure to cross-border business and tariff risk, as larger companies tend to have more cross-border operation.
Private equity, PE, activity is a major driver of deal volume. But the industry is currently facing a massive financial constraint: the PE exit backlog. PE funds need to return capital to investors, but stalled exits have resulted in over 30,000 portfolio companies remaining on their books by March 2025, with 47% held since 2020.
This creates immense pressure on the sell side to clean up financials and execute quick exits, which leads to the necessity of financial discipline.
Exactly. Dealmakers must prioritize a clear, actionable value creation plan from day one, integrating it into due diligence and execution. For corporate accountants, this means clearly identifying and modeling value drivers, whether that's margin expansion, top-line growth, or productivity improvements, and ensuring they are explicit and realistic.
What does the data show regarding pricing discipline during this period? Are buyers overpaying, or are they sticking to intrinsic value?
The sources suggest buyers are maintaining discipline and indicate dealmakers are not over or underreacting to volatility when assessing intrinsic value.
Our final topic focuses on how organizations are allocating capital internally, a core accounting function, especially between M&A and mandatory technological investment.
We know that big tech is pouring multi-trillion-dollar investments into AI infrastructure and capability development. How are mid-market companies balancing their books between investment and efficiency?
The distinction between mid-size enterprises and large companies is crucial here. Leaders at mid-size tech enterprises are primarily focused on efficiency and productivity, selecting these as their main goals.
So, for the mid-market, it's about shoring up the foundations first.
That's right. Mid-sized companies are prioritizing investment in tech infrastructure and cybersecurity in the near term. Their strategy centers on right-sizing infrastructure and operations immediately, whereas larger companies are focusing more directly on innovation and generative AI. This shows a tactical prioritization for mid-market CFOs, securing systems, cybersecurity, and optimizing existing processes, efficiency and productivity, before pivoting to larger growth strategies.
This suggests that success in M&A for a mid-market tech firm may depend on the buyer's assessment of how effectively the target has optimized its tech infrastructure and operations for cost and efficiency, rather than just raw innovation.
Precisely. In today's environment, where the margin for error is effectively zero, financial discipline is paramount. Just as a strong balance sheet and income statement are the bedrock of any business, meticulous financial modeling and rigorous diligence was the bedrock of a successful deal in 2025. Maybe even continues to 2026. Thanks everyone for listening, and we'll catch you next episode. Stay curious, keep evolving. Goodbye.
Take care, everyone.